The government is threatening to shut down Walmart. I'll show you why Walmart's latest move has angered government officials and is about to hit your wallet hard. I'm Steve Van Metre. Tariffs are slamming, your Walmart bill is about to spike, and government officials are pissed. Stay tuned. And while markets are melting down, our subscribers are soaring high with today's huge trade that's already up 3%. Want to be on the right side of the markets? Stay tuned to the end of the show to find out how. Now let's head over to Bloomberg, where we picked today's story up. Walmart faces heat from Beijing after demand for price cuts. The Chinese government has stepped in and is threatening Walmart. They're going to shut them down all over price cuts. And this is an issue because we know right now that U.S. consumers can't afford higher prices. So what Walmart did in China has angered the government in a big way, enough to garner the attention from the Chinese government, who's now threatening to pull the plug on the major retailer. Chinese authorities summoned Walmart executives on Tuesday over reports that it asked suppliers to bear rising costs incurred by increased U.S. tariffs. And so what Walmart's trying to do is keep prices low for U.S. consumers. And it makes perfect sense. Why? Because over the last 2 quarters, what have we heard from companies like Walmart? That they're seeing consumer pressure, that they can't afford higher prices. They're seeing less foot traffic. And when people come in, they're spending less. They're focused on staples, turning away from discretionary goods. Walmart's seeing higher income people start to shop at a store and using its app. And so all this is telling us is that consumers here in the U.S. cannot afford higher prices. So Walmart said, no problem. We'll just get the suppliers to pay for it. And Beijing says it's not a chance. As several Chinese authorities, including the Ministry of Commerce, have met with a U.S. retailer to learn about its negotiations over price cuts with suppliers in China. And so what we're seeing here is the Chinese government stepping in the middle of these negotiations and laying down the law with Walmart, saying, look, if you threaten our suppliers, if you bully them into cutting prices, well, we're going to pull the plug in your operations, and in a big way. But let's take a look at the charts and why Walmart is desperately trying to get suppliers to cut prices. They know U.S. consumers can't afford it. Let's take a look at this chart of the Consumer Price Index in blue against average weekly hours of production of non-supervisory employees, because what this is going to do is give us a complete, clear picture on why U.S. consumers can't afford higher prices. And Walmart knows this. They are fully aware if they push the tariff prices onto U.S. consumers, there's going to be major outrage. And we can go back to the late 1980s to get an understanding of what's happening now. We can see that prices rose, but at the same time, while workers were seeing their average hourly wage increase, you could see companies were cutting the amount of hours they were working. They couldn't afford those higher prices. We went right into the 1991 recession. Now we can see the same thing happen going to the dot-com bubble. Again, just like the 1980s, the issue wasn't wage growth. The issue was rising prices and hours. You can see, again, prices heading higher into the dot-com bubble. At the same time, employers were slashing hours. That meant paychecks were shrinking. And then what happens heading into the global financial crisis? We see energy prices soar. The CPI spikes higher. Employers are not passing that on in terms of more hours. In fact, they start to cut hours, and just a small cut in those hours leads to a massive cascading effect all the way into the depths of the financial crisis. And look where we're at now. Since around 2021, we've seen employers steadily cut hours, despite the fact that we see average hourly earnings running at a steady clip. But what these tariffs are threatening to do is cause prices to go higher. And what Walmart's admitting now is we're going to raise prices. We don't want to. We know our consumers can't afford them, but the problem is we have no choice. But yet, if we can get suppliers to take it at the margin, then maybe everything will be okay. The problem is the Chinese government is saying, you leave our suppliers alone. They're not taking the hit. You are. The Post said such demands risk fracturing the global supply chain and hurting the interests of both U.S. and Chinese companies and American consumers. Well, the problem is it's going to hurt everybody, because let's say prices do go up. What's going to happen is American consumers are going to spend less. We know they can't afford them, so they have no choice but to cut their spending back. Well, what does this mean for Chinese suppliers? Well, it means demand's going to go down, and in turn, their factories are going to cool off, and they're going to be forced to lay people off. So we're going to see this happen no matter who takes it at the margin, The only question is, who's going to pay? The question is, are you outraged? Hit the like button. I want to know who you think should pay for these tariffs. Should it be U.S. consumers? Should it be U.S. companies? Should it be Chinese producers? All of the above. Weigh in the comments. Love to hear from you, because it also hinted that Walmart could expect more action from Beijing if it continues to do so as the Chinese government lays down the law here. But let's take a look at some of their actions they're proposing, because on the CCTV affiliated post, they said that Walmart sourced around 60% of its products from China and warned that being condescending to Chinese suppliers could prompt local consumers to seek out alternatives, suggesting the Chinese government is going to tell consumers, stop buying at Walmart, go buy from your local supplier, as Chinese consumers know how to look for the suppliers that make Walmart products and purchase directly from them, and that would effectively shut Walmart's operation right down. And that is the issue that Walmart's facing. Threaten the suppliers, we're going to tell the consumers to stop shopping there. This is a big move by the government, who is saying very clearly, you can have all the tariffs you want, but it's American consumers that are going to pay. But something that's heading higher, that is their trading account for our subscribers today, who keep finding themselves on the right side of the market. My friends, you can too. Now, every day we look at machine positioning, and today it said there's a discrepancy on this chart right here. We told our subscribers, you can see very clearly, buy at open. This is from our notes today, and that trade already today up 3% as markets melt down. Want to find out more? Stay tuned to the end of the show. Hit the links in the description. Grab the coupon code for the 30-day free trial. We'll show you how you can beat the machines and be on the right side of this market. Any demands on suppliers, if true, would be bad for Walmart's operations and developments in China, meaning they could see massive losses as Chinese consumers start to spend elsewhere. But in terms of Walmart's hope to expand in the country, well, that could grind to an immediate halt. Walmart could be bleeding massive amounts of cash from this move. So we'll see what they do. But right now, the question is, who's going to pay for these tariffs? Again, I want to know from you. Weigh in the comments if you're upset by all of this. Hit the like button, cast your vote. I want to know, because its demands on suppliers show how rising geopolitical tensions are set to reshape global supply chains and pile additional pressure on U.S. consumers already facing inflation. Well, the problem is U.S. consumers are pretty much at the breaking point. We're seeing this in the surveys. They're telling everybody very clearly, we can't afford higher prices. We're worried about our jobs and our future income, and that's going to lead to less spending. So regardless of who pays for the tariffs, that's what I'm trying to say. It doesn't matter, because consumers here are tapped out, and when we're tapped out, well, that back feeds to suppliers all across the world. But Treasury Secretary Scott Bennett downplayed the concerns about tariffs, saying Chinese manufacturers will eat the extra costs. Big box retailers like Target and Best Buy have warned shoppers should expect higher prices from the trade war that's also ensnared Mexico and Canada. Well, one of the problems here, suppliers don't have big margins. They usually run somewhere around a 2% margin, so they can't cut. That's the issue here. Now they can go down the supply chain and ask for concessions. The problem is there isn't a 10% margin here for them to go down, meaning at some point this tax is going to be passed on to U.S. consumers. Walmart is saying that is coming. That's why they're asking their suppliers to cut their prices, because the suppliers won't. Well, there's no choice. It means U.S. consumers are going to bear the brunt of this. And let's take a look at what that means for Walmart and all kinds of other retailers across the country, as we once again look at the consumer price index in blue against advanced retail sales in red. And what do we see? As prices are rising, as hours work slow, what that means is there's less spending in the economy, and we could see retail sales decelerate right into the dot-com bubble. Let's take a look at what happens going into the financial crisis. Again, energy prices caused the CPI to soar. That meant less money to be spent on the discretionary side of the economy. We see that hit retail sales that start to decelerate and ultimately contract in the middle of the financial crisis. So we can look back at history and see what rising prices are already going to do. It means there's going to be a cut in spending, and then again, it's going to backfeed to Chinese suppliers one way or another. It's going to be in everybody's best interest to try to cut at the margin. The question is, will they be able to do that? Because right now, what Walmart's saying is, look, we're going to raise prices. We're doing everything we can to keep that from happening, but it looks looks like we have no other choice. That means consumer prices likely to head higher despite the latest CPI print. What that suggests, retail sales likely to head down, Walmart stock likely also to head down, and you're going to see China's economy continue its downward spiral into a recession. Again, if you're angered by these tariffs, hit the like button. Again, weigh in the comment, who should pay? I want to know from you, because even before the latest salvo, Walmart chief executive Doug McMillon had warned some shoppers are buying smaller packs of goods as they run out of money. There's the key words, run out of money before the end of the month. So Walmart's already confirming what we know about the U.S. consumer. They can't afford higher prices. And as it is, they're spending less. They're going to the store fewer times. And when they are there, they're buying less goods and services. And that means, as Walmart has indicated, by the end of the month, many of their shoppers are out of money. This is a dangerous sign. Tariffs threaten to plunge the U.S. economy right into a stagflationary recession. But Walmart's not the only one with issues, as Dollar General shows signs of easing believes. Well, that's generous at best, as Dollar General is pointing to a stronger performance in the consumables category, but declines in seasonal and home apparel. So what are we seeing? Declines on the discretionary side of the economy as consumers are bearing the brunt of higher rent, higher food prices, and higher energy costs. Again, as we said, with fewer hours being worked by many Americans, this is leaving less household income, less money to be spent in the economy, and again, backfeeding all across the global economy and supply chain. And that came even as customers remained under pressure, with some shoppers pulling back on necessities. So you can see how bad it's getting for a lot of low-income consumers. They can't even afford the necessities. Walmart's saying, look, they're running out of money before the end of the month. And now you can see why U.S. executives are turning more pessimistic as Trump policies sink in. Less than half, or 47% of U.S. business executives polled by the Association of International CPAs, said they're less confident about the economic outlook for the year ahead, which is down from 67% of respondents in a survey conducted back in December. The findings coincide with recent data showing eroding consumer sentiment and rising inflation expectations. And if you're less confident about the economy, hit the like button, weigh in the comments. I want to know what your perspective is, because when we look at the University of Michigan Consumer Sentiment Survey, and we see this in the Conference Board survey, what are we hearing from U.S. consumers? Their confidence is plunging. And why Walmart's worried, why Dollar General's worried, it's very clear, because when confidence goes down, as you can see here in the late 1990s going into the early 2000s, is retail sales decelerates and heads down with confidence. Because again, confidence is all about incomes and about future incomes. And when that goes down, when the labor market starts to weaken, consumer spending drops in a big way. You can see that happens again going to the global financial crisis, consumer sentiment plunging, retail sales with a lag comes crumbling down. And you can see that in different periods through 2012 into 2014. Right around 2015 and 2016. You see it heading into the pandemic, and look what we're facing now. And consumer confidence surged back in 2022 as consumers believed that we were on the cusp of another major economic expansion and bull market. Now what we're facing is the reality that we were already in the midst of the early stages of an economic slowdown. Consumer confidence now plunging. What that means, retail sales likely to head lower in the future. And it's not just about the fact that we're going to see higher prices from the tariffs. It's about the fact that incomes are slowing and consumers can't afford prices where they're at. The issue is we're facing a stagflationary recession, and it may be here sooner than people think. And there's a lot of warning signs right now for business executives, particularly around inflation, payroll costs, and consumer confidence. And the key one right there is payroll costs. Again, we talked about how Trump brought in all the CEOs, and I can promise you, he told them, do not lay people off. The reality is, when stock prices head down as there are now, you're going to see executives be forced to lay people off as they hope to defend their margins. And on top of that, tariffs are adding another layer of uncertainty. But what this means for producers who once said they were going to raise prices, well, looks like they're unable to, as U.S. producer prices stall while details suggest firmer Fed gauge. Now, what did we know over the past month or so is that we saw from the manufacturing sector that input prices were rising, and they said very clearly, we're going to pass this on to consumers. And that was interesting because it was going to be a problem because consumers can't afford prices where they're at now. So what's going to happen? Well, as it turns out, we saw a lot of inventory building, particularly at the manufacturing level. And as they're finding out, you can't pass these prices on because no one's going to buy it. And the producer price index was unchanged from a month earlier, following a revised 0.6% increase in January. Excluding food and energy, the PPI declined for the first time since July as demand from U.S. consumers plunges. And one reason we know the consumer price index was likely to stay somewhat elevated is you can see the relationship between the CPI in blue and the producer price index by final demand in red. And we can see final demand has been rising at the same time we've seen a deceleration in consumer prices, indicating that producers were taking it at the margin. And the problem is they were getting tired of that. But the reality is now they have no choice because there's nobody that can afford their products. And the drop in margins tentatively signals that consumers will be shielded from some of the forthcoming increase in manufacturers' selling prices and import prices. And that is true. If you can't sell your products at today's prices, how are you going to sell them when they're 10% more? You're not going to be able to. Again, this is going to force everyone across the supply chain to take a hit at the margin. The problem is for the equity market, it means revenues and profits are about to plunge. And with consumer confidence weak and many people already have brought forward purchases of durable goods, demand for goods will be very weak later this year, which is something I've said would happen, forcing retailers to accept thinner margins. And that may be a generous case because we talked about how going into the tariffs that people were pulling forward in demand. They wanted to buy now before prices went up. And what did you see? This caused manufacturers and retailers and wholesalers to build up inventory, which we said they wouldn't be able to sell. Not only are they going to take a hit at the margin, but they may be forced to sell some of that at a loss. And let's take a look at how this impacts the labor market. Well, for the moment, initial claims remain relatively low at 220,000 seasonally adjusted. Continued claims dropped 27,000 to 1.87 million. And even more impressively, continued claims dropped 67,000 to 2.163 million. The problem is this number isn't likely to continue to drop as more Americans face uncertainty in the labor market and as employers look to deal with rising payroll costs and shrinking margins. But something that should be a boom for you, that's your trading account. This is a trade we told our subscribers to put on today. That's right, we told them last night, we gave them the brief. We said, look, price keeps holding support, buyers continue to show up. It was all about machine positioning because our report flagged it, we reviewed it, and what we're seeing here is machines were looking to buy this position to expand on their already long positions. And how do we know that? Because every day we run machine positioning across the broad equity, bond, currency, and commodity markets, and we have a back test. And here's the best part. This showed up on our hot list of big trades, and we reviewed it and said, yeah, you want to take it. Now our subscribers are up 3%, and you too can jump in on our next big trade. How do we do this? Well, every day we run a report that looks at machine positioning, and then it overlays our back tested results to give us a hot list of trades. We review those trades every day to give you the insight on which ones we think you should take. What do we look for? Well, we look for major deviations in machine positioning. We look for when they have to buy, and our historical model gives us the edge. And that's something you can take advantage of. There's links in the description for a 30-day free trial. Why do we give you a 30-day free trial? Because that's how confident I am that you can make money. Now, every day you get the report, here's the best part. You don't have to read it. We give you all the tradable signals, and then I outline in the notes on every report the best trades that I think you should take. We've run historical modeling. We give you risk control levels, and we give you a weekly update with revised stop loss levels. I disclose my personal trades. That's right, I trade these own reports. And again, you get that 30-day free trial. Jump on that. Start making money in a market that's melting down. We'll show you how to do that. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.